Good morning, everyone, and welcome to our DAT Weekly Market Update. This is our update for July 25th, 2023. I'm Ken Adamo, Chief of Analytics over here at DAT, joined by Dean Croak, Principal Industry Analyst, and a very special guest, friend of the show, Dr. Jason Miller, who I think with the title change is now Professor of Supply Chain at Michigan State University, correct?
Yep, that is correct.
Congrats. Are you still department chair?
Yep, one more year.
Not that you're counting or anything.
No, not at all.
So Jason has the unique, he occupies the unique status of being both a Buckeye and a Spartan. So I can only throw so much shade. He's not like Matthew Leffler, where I can lay on the full rivalry with the state up north. It's only a partial rivalry because he is a Buckeye alum. So welcome back to the show. Hopefully you're staying cool up there. I heard it's hot.
Yeah, it's 90 degrees here, which for us is like panic time. Heat advisories and everything else.
Air quality's been terrible in this part of the country. I mean, usually that's like a point of pride for us. It's like not, it may not be sunny all the time, but we don't have the wildfire smoke and all of that. It's just been, I don't know if it's made its way up to you, but it's just the air quality has been terrible in Ohio all summer.
Oh, it's been, I think, even worse up here right now. I mean, I think right now Canada's top export to the U.S. is smoke.
Narrowly edging out maple syrup and kindness in that order. All right, so we've got a jam-packed show today. There's a lot going on, as you may be aware, our listening audience, and it's great to have Jason here today. We're going to hop into our market update so we can spend ample amounts of time bringing Jason back at the end to talk about all that's happening in freight and logistics. So key trends that we are watching. Spot rates are pretty much as seasonally expected. It's hard to believe, given where we are in the freight cycle, that spot rates are probably of the least talking point out there at the moment. More on that later. Contract spread versus spot narrowing, 49 cents a mile is the lowest in 12 months on a percent basis. That's actually flipped, which I think is really, really interesting. A percent change year over year basis. June Class 8 truck orders surprised, being up almost 10% year over year. Cancellations lower. Again, all of the signs rolling in that the market is poised to enter into the next phase of its long-term cycle. June manufacturing softness continues. This is something we're going to poke at with Jason towards the end of the show. With a steep decline in paper manufacturing where activity is down. And I think it goes without saying on this slide, we are still very closely watching the two elephants in the room, one of which would be yellow, the other which is brown, which is UPS. Two colorful things to talk about at the end of the show. So with that, I'm going to turn it over to Dean and walk us through the market update.
Yeah, thanks, Ken. Let's have a quick look at some of the market activity this week. Remember, the long-form version of this report will be published this evening at dat.com/market update. You'll find all the graphs and more of the detail there this evening. Let's start off with load truck ratio and dry van. Except for 2019, spot market load posts were the lowest in 7 years for week 29, down 8% last week. Volumes are tracking around a half of what they were a year ago, at the midpoint in what's known as the dog days of summer, which officially refers to the 20 days before and after last Sunday. So we're right in the middle of that. It's kind of a Malaysical type market. Load posts are about 17% lower than we typically see them for this time of the year. So definitely lower activity in the spot market. Load truck ratio down slightly to 2.49. In the refrigerated load to truck ratio, volumes are almost identical to this time in 2019. Last week, they were down 6%. Load posts for all refrigerated temp settings are just over half what they were a year ago, of course impacted by lower produce volumes in the 32 to 45 degrees Fahrenheit range. Equipment posts about 1% lower than 2019, tracking at 3.65 this week compared to 2019, as you can see from the chart, when they were at 3.15, tracking very closely to that year. In flatbed, underpinning the softness in the market, the lowest volume of load posts in 7 years was recorded last week. Volumes are down about 21%. To put this into context of just how slow things are in flatbed, volumes are half what they were in 2019 when the freight market was oversupplied. Load to truck ratio down to 6.32, the lowest we've seen since 2016. Having a look at some of the highlights in the market condition index, we thought we'd see a little bit of activity in the Pacific Northwest after the 2-week strike. No material evidence that the port workers' strike pushed more volume into the spot market. At $1.32 per mile for outbound Washington state loads. Rates were slightly higher than this time in 2019 by about 5 cents. In the larger spot market, Seattle, capacity actually loosened, rates down 5 cents a mile to $1.12. On the benchmark lane out of Seattle, south to Los Angeles, loads were paying carriers just 54 cents a mile. That was the lowest in 12 months. Remember, folks, these are line haul rates excluding fuel. You'd have to add the line haul surcharge for the fuel surcharge, back into that. Having a look at a couple of other markets, San Francisco and Stockton, capacity was flat last week. In San Francisco, spot rates are up 3 cents a mile to $1.88. In nearby Stockton, rates are up 2 cents a mile to $1.82. Some tightness in capacity in the Flagstaff market, rates up to $1.83, 2 cents a mile higher. In Allentown, rates are up 2 cents a mile to $1.54, while next door in Harrisburg, rates decreased to $1.56, down by a penny per mile. Quick look at some of the other top 5 markets in the country. Capacity was flat in Elizabeth, New Jersey at $1.42 for outbound loads. Atlanta, capacity eased last week, rates down 9 cents a mile to $1.72. Chicago and Dallas followed a similar trend, rates down 5 cents a mile in both markets to $1.95 and $1.55 per mile, respectively. In the refrigerated market, having a look at some of the West Coast markets to start the report off, capacity tightened slightly in Stockton, where we're seeing the tail end of the cherry season there. Rates are up 3 cents a mile to $2.41 as a market average. State level rates in California flat last week at $2.48. Comparatively, that's about 36 cents a mile lower than this time last week for all loads out of California. Of course, produce volumes are the big story in California, down about 34% compared to this time last year. That, of course, is causing lower demand in some of the major markets like Fresno. Rates dropped to $2.19 for the 4th week in a row. Rates have been dropping in that major produce market. In San Francisco, which is home to the Summer Salad Bowl in Salinas, Watsonville, rates were flat at $2.16 after dropping 9 cents a mile in the previous 4 weeks. And in June, the Port of Philadelphia was the #1 port for refrigerated import tonnage. In Philly, of course, it's home to the Packer Avenue Marine Terminal, where we get a lot of imports from South America. Rates are up for the 4th week in a row to $1.88, following last week's 8 cents per mile gain. And in flatbed, since this year's high of $2.36, Texas state average outbound spot rates have dropped 17 cents a mile to $2.19. The Dallas market reported an increase of 2 cents a mile to $2.17 after falling for the prior 3 weeks, while in Houston, the largest spot market state in the state for flatbeds, rates decreased 2 cents a mile to $2.33. The benchmark lane we watch out of Houston is Houston to Fort Worth. Capacity eased last week. Rates hit a 12-month low of $2.61 on that lane. And the other big lane out of Houston is of course, El Paso. Capacity loosened last week. Rates dropped to $2.56, the lowest in 12 months. And in year over year, look at spot rates to wrap up our market report. Line haul rates in dry van continue to ease, down 3 cents a mile last week at $1.66 per mile. The national average is 29 cents a mile lower than this time last year and tracking about 10 cents a mile higher than this time in 2019. In the refrigerated market, at the midpoint of what's turning out to be the hottest single month on record, the July reefer spot market is following seasonal trends and cooling off rapidly. Line haul rates have dropped 11 cents a mile since July 4, following last week's 5 cent per mile decrease to a national average of $1.97. And in flatbed, after peaking mid-May at $2.20 a mile, flatbed line haul rates have dropped 16 cents a mile in the 10 weeks since then. National average is sitting at $2.04 per mile. After being down 5 cents per mile last week, the national average is sitting about 39 cents a mile lower than this time last year. With that, it's over to Ken for the short-term forecast.
Thank you, Dean. We are getting closer and closer into some model disagreement, which is interesting, given how we've been in a bit of an alignment phase the past couple of weeks. So we always start with dry van. This is our short-term forecast, so it goes out 35 days. The blue line is the historical 7-day weighted moving average that just smooths out some of the bumps. It excludes fuel. It's long haul only. The green line is RateCast, our flagship model. The red line is a short-term model. And then the other two are blended models, which sort of straddle the fence between the two, blending in longer and shorter term artifacts to give a more measured approach. So I think what you see here is RateCast is just bouncing around a bit, which I think is very interesting, right? So the predominant seasonality right now is downward, right? This is a pretty strong lull in the overall freight cycle for truckload. I would say the number one slowdown happens after the Christmas and return shipping season. It's third or fourth week of January going into March. That's the slowest time on the freight calendar. This is one of the other slowest periods, is post 4th of July, before the back to school and Halloween and Thanksgiving and Christmas stuff starts shipping. So I think it's interesting that Ratecast is holding on to some strength, probably buoyed by some of the activity we're seeing on the volume side. But the short-term model isn't buying it. It's pretty much down and to the right. Let's go to Reefer. All right, this one's a little bit more alignment. So similar trend amongst the models, much more of a floor in place on the short term, however. But then kind of commensurately a little bit more upside on the green line, which is Ratecast, which again, I think is interesting that we're pointing up and showing any kind of strength given the dominant seasonality that Ratecast typically picks up on. Let's finish it off here with one that is in agreement down and to the right, which is flatbed. Again, if you go back and look at the chart Dean showed, or any of the charts that we look at on a year-over-year basis, this year is pretty closely following a lot of those years that look like an Appalachian mountain, so to speak. A slow build into early summer and then a slow decline in rates heading into the fall. I also think it probably ties pretty closely with what we saw in some of the manufacturing data and some of the slowing up north of building projects that don't get started, especially ones that won't complete before the white flurries start flying here up north. We're going to keep watching flatbed. It's a really interesting trend to keep an eye on, especially to see where we land and settle out once the seasonality sort of flushes itself out in the next couple of months. So with that, let's bring Professor Miller back and get to our question of the week.
Yeah, thanks, Ken. So, Jason, there's probably a million questions we'd like to ask you, and I'm sure our listeners have got plenty coming into the chat channel. But let's start off with a fairly easy softball one. What's your outlook for the next 18 months in trucking?
So I'd say right now, my best case scenario for a recovery would really be the second quarter of 2024, that we would start to see a rebound. The rest of this year is shaping up to be flat. We're seeing manufacturing activity seems to be moving along in a trough. Really, if you get outside of aerospace, which really doesn't generate that much freight, and especially the automotive sector, which is doing really well, we've just got essentially softness really everywhere, if not down year over year, in machinery, certainly in furniture and steel, plastics and rubbers down. Certainly wood products as well, given housing is cooler now than it was last year, though it does seem to be some green shoots there. A lot of wholesale trade, there's still seeing far too much inventory relative to sales in sectors like miscellaneous durables, which is toys. So if you think Hasbro, apparel wholesaling, way too much inventory relative to sales, electronics and things like that. So it's going to be a soft peak season for imports. So I think the best case scenario is we get into 2024, the Fed feels comfortable maybe lowering interest rates, 25 basis points, here and there. Housing picks up, inventories are more right-sized. Maybe we see manufacturing pick up a little bit, and that puts us in a much better position. One thing that hasn't gotten much attention, but U.S. containerized exports have been abysmal these last 2 years, especially in 2023. They're down 15-20% from where they were even in 2021. So we've got to get that export piece back, because that is a decent amount of freight volume from factory to the docks. So,
how much of that, Jason, is due to the stronger dollar versus some of the more predominant export locations currencies?
So I certainly think that's a piece of it, though we've seen just a lot of softness, especially in sort of the food manufacturing side of things, and can't overemphasize how critical food is for the trucking sector. It is by far the biggest source of full truckload activity. So the fact exports are down certainly is not helping on that front.
Yeah. Okay. Sorry to slow your roll there. I was just curious, as we think about that sort of import-export balance, it was bouncing around in my head how we think about relative currency strength in the global economy.
Yeah, no, it certainly has mattered. I think, the big thing is the sort of the double tap with inflation. We had too much stimulus in 2021, and then we had Russia invading Ukraine in 2022. causing all the commodity price spikes. And while commodity prices have come down from the highs where they were at in sort of April 2022, it takes a long time for a lot of these price increases to filter all the way down in the system due to, annual contract adjustments and things like that that's common in food manufacturing. And so, we're finally, I think, starting to feel those effects loosening. And consumer spending habits have changed. I mean, look at all the money that's getting spent on, Taylor Swift concert tickets. I mean, if a family of three spends $5,000 back in 2020, that was all going towards goods. And $5,000 is a heck of a lot of freight if it's coming as goods.
Not a lot of Swiftie merch, though.
Yeah, and I mean, it's not as much as I can tell, at least.
Yeah, it's quite the phenomenon. So you're pegging a recovery into Q2. I think it's probably a little more pessimistic than our thinking, right, Dean? We're probably more in Q1 timeframe. I mean, that's a hard time to peg a recovery given that massive seasonal dip we talked about.
And that's why I don't want to peg it then. Maybe on a seasonally adjusted basis, the recovery starts there. But I mean, Q1 freight volumes are just so darn soft. I think for when people will really feel it is, let's say we enter Q2 and the housing market's doing a little bit better. If we see a surprise on the housing start side, I think that would be kind of the biggest thing. And I do think once the Fed can start lowering interest rates, you're going to see some of that business investment come back. So the capital equipment side, that would be a good thing. The one wild card right now that we're dealing with is oil prices being as low as they are. We're starting to see drilling rig counts, slow but steadily decline. That's a lot less flatbed activity in West Texas, eastern New Mexico. And so that's certainly right now, low oil prices, while good for carriers, are a headwind on that flatbed market and that heavy machinery market.
Yeah, that is such a big piece, especially out west in the Bakken. And what's the southwestern shale? Dean would know this off by heart.
Permian.
Yep.
Permian. So, I mean, that's all. I think from a flatbed perspective, it's just things are just starting to reverse back to where they probably should have been. I do have we were with customers last week, and the thing that kept coming up is we saw kind of a rash of surprisingly positive economic data. And the question just from some of these top execs in the industry was, one, how do folks keep getting it wrong? And I guess the sub point to that was, why do they seem so disappointed when the economy keeps doing well in the face of estimated malaisical results?
That's a good question. I mean, I think on the housing side, we've got a really odd dynamic that even though interest rates are the highest they've been effectively in 20 some years, what we have is so many people are locked into their existing homes that the housing inventory is so low overall. Because typically, I think something like 80 to 90% of sales are existing homes, and we're not seeing that right now because folks are locked in on 2.8% mortgages. They're not going to move. So supply is so low, and that means that new builds are really the only source of supply right now, or they're a much greater disproportionate source. So that's paradoxically, higher interest rates are actually supporting the new build market by keeping supply of existing homes low because people don't want to move. So that's kind of a really odd one that I don't think anybody saw that dynamic playing out.
Yeah. I mean, until I heard that exact explanation of it, may have been from you, I may have read it, but we said on the show, it never made sense to me. It was always said as a truth, right? That when high interest rates went up, new builds became more favorable. I never quite understood why, but it makes total sense. Our dream house could come up on the market. I'm locked in at 15-year, 1.9%. Why would I ever leave my house? If I could go borrow the full market adjusted equity on it at that, I would, and I would just park it in a CD and I'd make 3% per year net. It's wild.
You know what, though, I think one of the reasons, the other thing that got missed so badly is I remember this time last year, everybody was talking about how consumers were going to run out of money and the economy was swiftly going to fall into a recession. And obviously that has not happened for the whole economy. Yes, trucking's been in a recession since Q3 last year. But one thing that never gets brought up is how many of us refinanced our houses in 2020 and 2021 and we've actually had housing deflation, whereas the official inflation statistics pick up housing inflation because you or me or any of us who own houses, inflation is measured as though we were renting our house, which in my opinion is a little silly. I get statistically why it's done. And when you look, I've come to really like the European approach for measuring inflation, which removes this owner's equivalent rent piece. And when you look at those data, inflation's now below 2% year over year. And so when you've got roughly 5 to 6% wage growth, depending on how it's measured, but probably a more accurate index of what are people actually paying, being at below 2, you've got fairly positive real wage growth. And that's what's supporting overall economic activity right now. And again, we're dealing with stimulus. It's just unprecedented. I mean, you have, I think it was Bank of America, one of the big banks had said, yes, checking account balances are still higher than they were in 2019, despite 40-year high inflation.
What's interesting, though, is that some of those same folks that are offering, research for a very high fee, right? They keep moving the goalpost, right? It's like, no, we promise consumers will actually run out of money this retail season. And that's like what I'm hearing more and more and more, both publicly available and privately available analysis that is suggesting that, it just didn't happen yet because we got a little reprieve in some of the inflation, but we promise this year's Xbox is what's going to put the nail in the coffin of the American economy. And I just don't, I mean, little old me with 2 state school business degrees, I don't know that I'm the expert here, but I think the common sense approach suggests, based on some of the data you've claimed and some of our own experiences, maybe we aren't going to run out of money this fall.
No, this is going to be, it's going to be a muted peak season on the import side, just because, again, we can see so many of these wholesale trade sectors have too high of inventories relative to sales. So they're going to be cautious. I think there's going to be a lot of caution with the retailers because they're not completely sure where the consumer's at right now, and especially with this desire to sort of have lived experiences. But to me, the concerns about a recession and us actually entering one this year, I actually view as over, because now we're seeing single family housing pick up. We're seeing manufacturing effectively troughing. We're seeing inflation adjusted wholesale and retail sales troughing. Retail may actually be rising a little bit. Gas prices are reasonable. And I think the one thing that's always challenging is how consumers experience inflation. It's not some mythical core inflation idea. People look at what's the price of food doing and what's the price of gas doing. And they're saying, well, food's more expensive than last year, but gas is a heck of a lot cheaper. And that is, I think, what really shapes consumer spending behaviors, rather than this, basically economic creation that we have of core inflation.
Yeah, I mean, it's over the course of human history, it is still remarkably cheap to live, right? I mean, I don't say that as someone who's thumbing them nose down, from the middle class. It's like for under $10, you can pretty much go from any 2 major American, in between any 2 major American cities in a car, right? Like it's still remarkable that you can go 150 miles in most American automobiles and still spend under $10. Like, I think when you put some of these things into perspective, it is still pretty remarkable that, I shouldn't say it shouldn't be that big of a surprise that the average American consumer hasn't ran out of money yet. How are wages doing, Jason? Like, that's the one thing I haven't checked on in a while. Are wages keeping up with where we would expect to make sure that we're not running into some longer term convergence of these 2 lines?
Yeah, so right now, the Atlanta Fed, they have a wage growth tracker that fortunately is now on Fred, so it's really easy to download. They're right now showing the 3-month moving average at 5.6% year over year, which for perspective is higher than the 1990s, where it was a little above 5. We were at about 4% in 2018 and 2019. So that year over year wage growth is coming down a little bit. It was peaking a little bit over 6% a few months ago. So there's no doubt the job market has weakened a little bit. We're not in sort of the peak period of 2022, but it's still an incredibly tight labor market. And the one good thing we're seeing is labor force participation rates for prime age workers, 25 to 54, are now getting back to 20 plus year highs. And we may actually, in a few months, if things keep going well, start challenging the highs from the 1990s. So, part of the reason probably for the softening of the labor market is we have more supply coming back in as those job market conditions improve.
Yeah. All right, let's pivot to a couple more timely topics in more of a rapid fire, because I think there's not a lot that hasn't been said about these two topics, and there's quite a lot of uncertainty. But so the reprieve that Yellow got from going out of business on Monday, is that something you see as long-term, or is just a little bit of a lifeline to prolong the inevitable?
My sense is it's just we're prolonging the inevitable right now. I mean, if you go back to 2014, I pulled their annual report. Yellow or I should say YRC and then all the regionals, so Yellow combined, was moving 58,000 tons a day back in 2014. By 2019, that was down to 41,000 tons per day. And in 2022, we were looking at about 30,000 tons per day.
Yep.
So we're talking a 50% reduction in tonnage per day. And yes, they've done the first phase of integrating YRC and Rudaway out west. They've still got to finish phase 2 of getting, Holland in the Midwest, New Penn in the Northeast, and YRC integrated. But when you take a look, their Q1 this year, their volumes were down 16% year over year. You can't help but think when you look at their April and May, they were down 16% year over year. I can't help but think July has got to be down 35, 40% year over year, with so many folks publicly as well as privately saying we're pulling volumes. So let's conservatively say they lost 30% of their volume. That puts them down to 20,000 tons per day. I don't see how this is survivable. And I think Ari Ashe at Journal of Commerce has said it best: if you didn't stop tendering to Yellow, move it to XPO or move it to Old Dominion, and then just suddenly decide to yank it back to Yellow in case 2 months from now it then has to go back to XPO if Yellow fails. Like XPO is going to just, sort of throw their noses at you. And so it's still a soft LTL market. If we were on a cusp of, let's say, really entering a bull market, I'd say maybe there's a survival chance. But when FedEx Freight has a 24% decline in tonnage in their Q2, which runs through, I believe, May of this year from the prior year, I mean, that's one of the best run LTL carriers, and they're losing 24% of tonnage year over year. This is not a good LTL market. And so I can't see, given the volume being pulled and how soft LTL is right now, how they're just going to make it much further. I just don't.
Well, if it's any consolation, most of that volume that was pulled was probably losing money on a variable hundredweight, right? I mean, like Yellow, as long as I've been in the industry and as long as anyone that I've ever talked to has been in the industry, Yellow/YRC has been the worst pricing, the most poorly priced LTL carrier out there, right? I mean, most LTL carriers excel on one of two things, or both if you're Old Dominion, but it's pricing and service, right? If you could be an amazing operator and afford to be a little lax on your pricing, but you can't not do both well. And Yellow was always the cheapest and the worst service. So you put the freight you could afford to put on there. But to your point, I don't know what they're hanging around waiting for, right? There's no major thing that's going to happen in Q4 that's going to whip the LTL market into it. I mean, unless UPS does go on strike, which we'll see an overflow into LTL, but I don't know that Yellow is going to be everyone's first choice to move that freight.
No, and I mean, if UPS strikes, I mean, kind of getting ahead of ourselves, it isn't going to be a long strike. Management has no incentive to we're not going to have a 16-day strike like we did in 1997, because the amount of cargo that's going to be permanently lost in that case is going to be, I think the figure I've heard is up to 30%, and I think you'll see that. Versus in the 1990s, I think I saw Bloomberg run the figure that UPS was something like 70 to 80% of the parcel market back then.
Yeah.
You really didn't have Plan B.
Yeah, I mean, I think that's the huge difference. When we're talking to folks that aren't as familiar, FedEx is a relatively young company, especially when compared to UPS, right? I mean, they were not nearly... did they even have FedEx Ground? I'm sure my own numbers.
They did not have
Yeah, they didn't
FedEx
acquire
Ground
from RPS by then yet. So they were primarily still exclusively priority air freight. So it's a much different environment They're two drastically different operators, right? When you just knowing what I know from being in that kind of machine, UPS and FedEx operate dramatically different. I mean, their philosophies from top to bottom are different from an operations perspective. So it would be something to behold if UPS went on strike even for a few days.
No, and this is where I mean, they're coming back to the table right now. I think I saw at 11 o'clock there's going to be a press conference. You know, my take is, if you look, peak parcel activity, or peak, if we want to call it, courier and messenger activity, was in 2021, because we had the air freight activity. I mean, everybody keeps forgetting how much international air freight these two companies haul. And we had peak e-commerce demand. If you take a look at Census Bureau data, really what happened was the parcel market had a big secular drop in Q2 of 2022 once we got past the Omicron surge. Everybody forgets how Omicron just really whacked things out in Q1 of 2022. Once we get past that, volumes dropped about 5-6% year over year. And then this first quarter, they did another 5 or 6% drop. And so right now we're seeing real activity kind of running around where it was in the second quarter of 2020. So we're like 8-9% above pre-COVID, but we're not the 25% above pre-COVID. And so as I look at it, if I'm UPS's management, I've had the 3 most profitable years in UPS's history in declining order: 2021, 2022, 2020. 2023 is going to come in, assuming no strike, darn near 2020, if not higher than 2020. So I'm looking at my 3rd most profitable year ever. We're talking $10+ billion. I've got a lot of excess capacity. The most excess capacity we've ever had in the parcel sector is today, right now. So I'm staring at losing a decent percentage of my market share. And I have the financial resources to give the Teamsters what they want. And I have the tightest labor market since, either 2019 or probably the 1990s. So it's right now the union is in the driver's seat. So,
I mean, my thinking on this aligns with everything with what you just said. I think the only way this goes to strike is if that's sort of the point the Teamsters want to make. Among the rank and file, there is still a profound distaste for how the rail sort of labor negotiations came to an end, with essentially one of the greatest labor backstabs in the history of North American labor politics by Congress. And I don't know if O'Brien's ultimate end game is on the 23rd hour of the first day of the strike to sign on the dotted line to something he would have signed today. Yeah, it's impossible to know that, right? I mean, I think all reason points to this thing being settled today or tomorrow. But again, a lot of these things haven't broke labor's way over the last couple of years, right?
Yep. No, and I'd say the other thing too is just, when you look at the situation, you had 97% of the Teamsters authorizing a strike.
Yep.
That is a crazy high number, even in comparison to, let's say, the railroad unions, where the strike authorizations were not, 97%. And so you can just tell, and, UPS, the corporate executive bonuses the last couple years, because they've been record profitable, that has really angered and frustrated folks when you're looking at $20+ million compensation. So I think we do have a unique convergence of factors, and the fact that the Teamsters have a lot less to lose than UPS management here right now. So I think that's just, to me, why, if you're UPS's management, you kind of right now, you just don't really have a plan B at this point in time. This isn't 2021 where conditions were so tight that it was like, look, customers effectively still can't leave us because there's not a shred of excess capacity.
Yep.
In the sector.
So we will see. I mean, it's going to be a dicey. I realized today it was 6 days, right? The contract expires in 6 days. So I do expect in the next day or two we will see movement, probably a handshake agreement by the end of the week. But I wouldn't expect ratification. To me, I think the biggest wild card here would be if there's a handshake agreement in place with the Teamster leadership that doesn't ultimately end up getting ratified. I think that's that's probably the most likely edge case, if that makes any sense. But given, to your point, the fervor around striking and making a point here, I could easily see a sketchy deal not getting ratified if it doesn't meet all the needs of the rank and file.
Yep. And the Teamsters have said as long as there is a tentative agreement, they will keep working. But Ken, per your point, I think in some cases, if you're UPS's management, the worst thing right now is uncertainty. Because let's say there is a handshake agreement, but it's not that good of a deal. Are we looking at it goes through it's going to take 3 weeks to ratify? Are we looking in mid-August and the Teamsters say, no, we're not going to ratify this. And then all of a sudden it's like, oh crap, where are we at now? And you're going to have shippers this entire time that are going to say, you know what? Do I want to take my risk of my back to school stuff getting stuck in UPS's network? And I think the answer to that is going to be a no. So I think
go ahead.
No, I think if you're UPS's management, you have to come to the table and basically meet what the Teamsters want, because I don't think you can take that risk. And again, I mean, if you're UPS too, the other elephant in the room is, 30% of your packages are coming from Amazon. Amazon is continually vertically integrating itself away from you and or diverting it to USPS. You have to start asking yourself, I can't, be a risk for every other shipper not named Amazon, because there is a essentially secular almost decline in their parcel volumes as Amazon keeps vertically integrating itself.
Yeah, I mean, I think the final point on this is, at least, I think everything you said is true, but in my opinion, the thing, the turtles on the beach, right? The poor seagulls covered in oil in this particular instance will be the pharma and cold chain, like the absolute tip of the high value spear. I think most media outlets will hone on that, and that's something that's not super fungible between carriers. A lot of these, especially the precisely temperature controlled pharma and biologic and reagent products, are validated on one carrier. I mean, one route with one airplane is how specific some of this stuff gets, and that stuff cannot just be switched over to a commercial flight or a FedEx flight. So, thankfully, Markin, the high-end pharma shipper carrier that UPS acquired in 2016, moves most of their stuff on commercial lift, so that's at least a benefit. But again, for ones that are using UPS Direct, I think that's something we should keep in mind.
Yep.
No, any final thoughts, Jason, before we wrap? This has been great, but we're running long.
No, nothing else other than, I think the best case scenario for shippers right now is, Yellow somehow, again, Cat with I don't even know how many lives right now, they somehow make it through this situation. And then obviously no UPS strike. I think the most likely scenario is no UPS strike, but Yellow. I will be surprised if Yellow's here by Labor Day. I just don't know how that's going to happen.
I think Yellow has a high degree of likelihood and a low degree of impact. UPS, very low degree of likelihood, extreme level of impact. That's sort of my XY. All right. Well, thank you for coming on today. We'll have you back on in a couple of months or a couple of weeks, whatever. Dean does all the scheduling. It's always great. We always run along in these conversations. So I'm thankful you were able to come on and join us. Any final plugs, Dean? You've been quiet today.
Yeah, no, been fascinating discussion. A couple of shout outs. Sales chatter tomorrow, 11 a.m. Eastern with Dan Deegan. Robert Rouse is on Landline now, as always, Wednesday, 7 p.m. Sirius XM. I'm on Radio Nemo this week with Jimmy Mack, Thursday at 8 a.m. Channel 146, Road Dog Radio. Our latest issue of the Freight Bind podcast, where Professor Chris Kaplan is talking to DAT CMO Jeff Hopper, talking about fraud. Don't forget our new DAT website is up, dat.com/fraud-protection. That's been established to help protect and educate everyone on the ongoing fight against cybercrime and fraud. A couple of big events coming up, October 1 to 4, CSCMP. Our shipper team's going to be there. Our invite-only shipper and broker summit is on October 10 to 12. That's DATCon in Houston. And on next week's show, our special guest is Dustin Jalbert from Fast Markets, talking about lumber and the building industry. And with that, it's back to you, Ken, to wrap up the show. All
right. Like I said, I want to thank Dr. Jason Miller for joining us. He's He's the social media monitor of freight frivolous claims out there on LinkedIn. I highly recommend giving him a listen or a like and subscribe, whatever they call that on LinkedIn. Keeping the freight reporting industry honest, and probably the biggest advertising agency for freely available government data that exists today. So probably more Fred traffic has been redirected by Jason's posts than anyone else.
You know, I'll tell you, the one thing that stunned me is the Fred app has something like 10 million downloads. And I'm like, I would never have thought that. There's a lot of nerds out here who love government data, I guess.
Yeah.
Hey, I'm a huge fan as well. So thanks, everyone, for joining. We hope you have a great week. We hope you stay safe, stay cool in most parts of the country, and we will see you next week at 10 a.m. Eastern. Bye, everyone.
Thank you. Bye, everyone.